Good morning and welcome to MFC Group's FasTech Seminar Series. Thank you for joining us for Electronics Market Outlook 2026, Trends, Risks, and Opportunities with Dennis Reed. Our session this morning is scheduled for an hour and everyone's muted, so feel free to type any questions you may have into the chat and we'll monitor those questions and address them at the end during the Q&A. And at that time, I'll allow everyone their microphones if you'd like to ask a question. And we are recording the seminar and we'll send out a link to the recording and the slide deck to everyone attending in the next few days. Our presenter today is Dennis Reed, Senior Research Analyst in Technology for Edgewater Research. Dennis started in the industry in 2005 at FTN Midwest Research on the technology and semiconductor team. In 2006, he was a founding member of Cleveland Research Company and continued to develop an extensive network of technology industry professionals in the semiconductor, distribution, memory, and HDD industries throughout the world. Dennis is an expert and thought leader and will share his insights on the technology market now and into the future. And welcome, Dennis. Thanks so much for being with us this morning.
Good morning, everybody. Amanda, thank you very much for having me, and thank you very much for the kind introduction. Have a lot to cover today, so I'll jump right in. As Amanda had mentioned, with a lot to cover, please feel free to fire away questions. I will give everybody a fair warning up front. We'll cover a lot of data today, but hopefully you find this of value. I know I always enjoy partnering with Mel Foster and the team. So an agenda for today, first and foremost, just to tell you who we are and what we do at Edgewater. Secondly, we'll call it the topic that we hear from everybody. The number one question that I get: what's going on with memory? Is it real? And what's the fix? So I'll try to cover that in a memory market update, and then ultimately drive into the supply side, demand side, and then wrap everything up today with our outlook for the year, or for the remainder of the year, I should say. So with that, who are we at Edgewater? We're an independent research company based in Cleveland, Ohio. We specialize in the technology, internet, and then consumer e-commerce space. We work with the largest money managers in the world who invest in technology companies, providing critical business insights through what we call a fundamental research process. And our reputation dates back over 2 decades, collectively just on our hard tech team. Between my team in the component space and our compute team, I think at this stage we're north of at least 70, if not 80 years of experience doing this collectively. So long way of saying we've been through a few of these cycles. Each is unique and different. But of course, we've seen a few things in our time. Ultimately, why do our customers work with us? As I mentioned on the previous slide, the fundamental research process. We're deeply connected in the industry. We'll say through our fundamental research process, we're engaged with people from sand to silicon, through distribution, ultimately to the EMS, customer level. So trying to gain a holistic view on the supply chain. That's our bottoms up or fundamental research process. And we also marry that with a top-down approach where we engage with the C-suite across many of the leading technology companies. So we're looking at, one, the strategy, but two, we're also looking at the tactical implications of the strategy when the market conditions ultimately change. As I mentioned, we're a trusted resource for the investment community. Ultimately, it's important for a couple of reasons. One, it obviously keeps the lights on here, which is hugely helpful to be able to do it. But two, and equally as important, it does give us a line of sight, because these people, both in the public and private space, they are the ones ultimately funding all of the R&D projects that each and every one of you are currently working on. So we get a line of sight into where capital is being deployed, what it's being invested in, which ultimately shapes our insights that we could provide for our industry customers. And then lastly, we are a critical partner with many of the largest technology companies. We work with multiple functional areas, from sales, marketing, purchasing, C-suite, etc., working with them to identify the trends and shape their strategies to ultimately capitalize and create opportunities for their business in the very dynamic marketplace. Couple of ways to engage with us. I'll just leave it up, either a channel confidant or subscriber. And then a little bit about myself. Amanda covered it. Did start back in 2015. I know that's longer than 15 years, or sorry, 2005. I know that's longer than 15 years ago. I took a mid-career pause where I did a couple of different things with Travelers Insurance in the property casualty space around strategy, product development, sales management, and then also field sales. A 2002 graduate from Ohio University with a sports administration degree. Yes, I know that doesn't, it is not used at all on my daily basis. My contact info is here. As well, I'll provide Amanda to share with you guys all the slides after the webinar today. So any questions, any interest, please feel free to reach out. Happy to help in any way possible. So to start, as I mentioned in the agenda, the number one question I have gotten from manufacturers reps, from distributors, from suppliers, EMS customers is candidly, what is going on in the memory market? Is it real? And is there any relief here in the near term? And the answer to two of those in one line is, I'll tell you what's going on here in a minute. And is there relief? The short answer is no. I'll walk through, a hypothetical way that we can ultimately get through this. I'm only going to cover the DRAM space today, but what I would tell you is if you look at the story on the DRAM side, it would be the exact same story in the NAND flash side for time, etc. I've just chosen not to throw both of those up. So we'll start with DRAM. So what's going on in the marketplace right now? So as you can see, this is our forecast by PC, server, mobile, consumer/other, so embedded markets for demand bit growth by market segment and an overall year-over-year bit growth. So a couple of things here that jump out to me. First and foremost, from a demand bit growth, or what the customer base is actually forecasting to consume in 2026, it's a 25% number. And yes, that is at the higher end of the data that we're showing here going back to 2015. But again, a 25% year-over-year bit growth is actually not that far out of bounds from a demand standpoint. And as you can see, the breakdown across the segments, your biggest jump is in the server segment. I'll touch base on what's going on there when I go more to a unit basis. But again, we're seeing strong server consumption, or at least, forecast for consumption. So, a couple of things playing out here from a demand segment. Again, in line with relatively historical norms. As you can see, we've kind of hovered, and the way we think about it is demand ultimately grows from a bit standpoint. Call it in the mid to high teens to, mid 20s is kind of considered normal. If you look at the years in the chart here, really there's only 2 years in 22 and 23 when the world fell apart coming out of the COVID shortage. Outside of that, again, the demand environment's here. So if you look at this in a vacuum, I think the easy thing would say is we shouldn't see prices up where they are. However, the important factor is this is largely being supply side driven. So that was demand. This is production across the big three, so Hynix, Samsung, and Micron, and then the industry overall. So as you can see, two things jump out to me. One, we're growing production this year at a 19% clip. So there's roughly a 6 percentage point gap between what demand is and what supply is. That in and of itself, I could wrap up the whole memory segment. I'll show what's going on with pricing here in a few slides, but that is ultimately what is driving the current environment from a memory standpoint. We are simply ordering too much and not able to produce it. A couple of other things I think is worth noting. You look at that 2022 number, and again, I would say production growth typically runs somewhere in that, high teens to 20, mid 20% range. That's considered normal. Again, couple of things going on here as well. You look to 2022 when the bottom fell out. We know everybody cut their CapEx back significantly, including the memory guys. So in that case, we had a year of 1% growth 2023 was a subnormal year, and then we ultimately entered a pattern of normal. But that year or two or below certainly impacts the growth rates going forward. So again, that's memory in a nutshell. As I mentioned to start, I could run the same exact slides. They would look roughly the same. The big difference is, everybody knows, between flash and DRAM is ultimately there's three guys in flash, big guys, I should say, or three big guys in DRAM, roughly five big guys in flash. So you could argue maybe there's a little bit more discipline in terms of CapEx deployments. But again, the net of it is here, we're short because simply the demand is at the higher end of normal and supply growth is simply at the lower end of what we would consider normal. So with that being said, is there relief on site? My first answer is no. So what I could tell you is the good news with this scenario, and I'll touch on it later in the supply side with a little bit more detail across the CapEx environment overall. The ultimate driver to fix the current scenario we're in is increased wafer starts or increased CapEx. The good news with that is the major suppliers have significantly raised their CapEx environment. To give you a couple of numbers, we'll take Micron. For example, their fiscal year ends in August, so for fiscal 26 would be August of 26. Their original CapEx budget was somewhere around the 18 billion when they reported their results in December. They raised that to 20 when they reported their results a week ago, I think. They raised it to 25 billion. So they are spending to come back. Micron also put up, 76% gross margins and guided their gross margins to 81%. So they're certainly not hurting right now. But again, they're spending more. Hynix is another proxy of spending more. They forecast their CapEx on an intensity basis, so meaning CapEx as a percent of revenue. They've historically run, somewhere in the 10% of sales. They've raised that to 15% of sales in January. You run the math on that higher percentage and the higher sales volume. If they hold to that number, they'll actually spend more CapEx than TSM this year, who's obviously the largest foundry in the world. So money is being deployed to fix this. I think the one thing that holds true in the memory space, but ultimately everywhere in the industry, is what goes up will come down. So I'm not naive to say, even with three suppliers in the DRAM space or five in flash, that price will continue to go up forever. I think the one thing that is true and told is when you get into a market like this, they 100% will overshoot it at some point. So ultimately, what does this mean?
Hey, Dennis, before you
Yeah,
move on, can I
sure,
interject with just a couple questions? Um,
absolutely.
so on the previous slide, why does the 2025 still show an E on it? Does that stand for estimate?
It still stands for estimate. The last time we updated, we were just frankly waiting for everybody to update their actual numbers. And that's basically it. It's just a timing of when you see the financial reporting, in particular out of Asia.
Okay. And then we have one other question. Um, and you may want to wait till the end of the section because we may have several, but what impact does memory shortage have on the industry?
That is a great question, and Amanda, to your point, I'm going to table that one because I'm going to address it at various stages through the demand section. So I'll touch on it on each individual level. So I think it makes sense to hold it there.
Okay, perfect. We'll pause until we take a break for the next section.
Not a problem. So I walked through I walked through the why we're here, what does it mean, and I just wanted to pull these up for example. So I pulled the mainstream PC and server densities at DDR5 and what our estimate is of the contract pricing per month and then averages out for the quarter. So again, if you look at just the 8 gig DDR5, 63, 66, 68, you average it out for the quarter, you're roughly at 65 and 2/3. That's a 90% quarter over quarter number. it's a 217% year-over-year growth. Same thing as you run through pricing, we have forecasted ultimately to go up until it kind of stabilizes starting in the fourth quarter. But net for the year, when you look at each quarter, you're looking at a 217%, 242%, 222, 28%, and then 135% year-over-year growth. So the net of that shortage is ultimately what is driving the price here. And then again, if you look at the server side for the 32 and 64 gig DIMMs, very similar story, obviously slightly different numbers. So at the crux of this, how are prices going up this high? And again, I'll dig more into this in the later section on demand, but right now in the current operating environment, the elasticity equation has not appeared in the hyperscaler market. So if you think of guys like AWS or Meta or Microsoft, right now, if they were planning on buying, to keep it simple, 100 gigs of DRAM at $6 a DIMM, and that ends up being a $600 spend. We know those numbers aren't right, but if at the end of the quarter a Micron or a Samsung comes back to them and says, I'm sorry, the price was actually $7 a DIMM, they'll just pay the 700. So they're still in an environment where elasticity has not mattered. And then ultimately with those companies being some of the most profitable and largest companies in the world, when elasticity does not matter, this is ultimately the environment from a pricing standpoint that you're in. To answer the quick question of, is there a fix to this? And again, the short answer is no. I think this touches on one of the questions I just saw pop up on CapEx delay to wafer starts. Where we're at right now, the incremental capacity that is the next slated, I should say, incremental capacity that is expected to come online is scheduled for mid-2027. So all else equal, in a vacuum, if the current operating environment stays the same, there is no change to demand, et cetera, and all, you can expect the market to remain tight with no capacity relief until the middle part of 2027. Now, to the second part of how long does it take, a good rule of thumb is, call it 18 to 24 months. So we've seen the CapEx, 12 maybe to 24 months, depending on if it's a new shell, fab construction, new line, et cetera. So again, we are seeing the CapEx budgets being raised. I think, what that ultimately means is, what is planning on coming out now will just be incrementally more wafer starts, incremental more spend on the back end, et cetera. So, from a supply side relief, no real relief to the market until probably the middle of next year at the earliest. The scenario when we can quote unquote get out of this is what I was initially describing with the hyperscalers. So, in that environment, I think it's naive to say that they're not stocking inventory even at these elevated prices. So if something were to shift in the marketplace, and again, I'll dig through that in demand sides, but if something were to shift in the marketplace and there's incremental more bits available, the conversation looks like, and this is ultimately what kind of started to happen in 2018 with the cloud build out, where Micron or Samsung or whoever it might be, they go to Amazon or Microsoft and say, we know Mr. or Mrs. Customer, you wanted 100 gigs. The reality is they probably need 85 or whatever the number is. But at these prices, we just actually came up with an incremental 10% more capacity. Would you like 110 this quarter? So if that scenario were to happen, you're basically calling into question the elasticity. We know they're building inventory. The hyperscalers tend to hold more inventory. So in that type of environment, they are not afraid to hit the brakes. From a purchasing standpoint, they did it in 2018. I think it's naive to say they won't do it again here. But again, that's your only kind of quote unquote out from the current environment, is to hope that somehow there is incremental capacity or wiggle capacity or cancellations elsewhere that ultimately frees up enough capacity that brings some incremental bits to the hyperscale market, and then they have a herd mentality and decide the market's not as tight, we're not going to order. That is a whole lot of ifs. So I think from a planning standpoint, from communicating with customers, if you're in distribution, supplier, rep world, I think the reality is more on a supply sufficiency versus hoping for any incremental correction here in the near term. So as we move out of memory, well, I'll touch base on the supply side of the market. So, I mentioned the CapEx environment, and you can see the dark blue portion of it. That's the memory side. For the initial question, waiting up on some final results out of Asia. That's why 25 still shows as an E. But as you can see from a CapEx side, when you look backwards, we had 3 straight years of double-digit growth. We know how that ended with the COVID period. We found religion as an industry in 23, and then we've since recovered from a CapEx environment. And I would say we've recovered at a very, very disciplined pace. The compute space, which is made up of Intel, AMD, the hard drive guys, the flash guys, and the DRAM guys, they're clearly the ones that are leading the spend this year in 2026. So again, as you think about it relating to memory, there is a reasonable belief that CapEx is coming. Supply is coming, but there's the lag between spend and actual wafer starts, which runs anywhere from, call it, 18 to 24 months. It will be time before that incremental capacity comes online. Secondly, I would say when you go outside of the compute space, the foundry space, which has also been tighter at the margin, it's kind of a mixed bag there. I would say, I think, leading edge technologies that are supporting the customers like AMD, like NVIDIA, like the Qualcomms, that capacity is running nearly, NVIDIA, if I didn't throw that in that list, that capacity is running nearly 100%. When you get into more of the trailing edge nodes, I would classify it as certainly lead times are extending. Certainly it's tighter at the margin, but the real bottleneck is just that time to increase wafer starts versus the wafer outs, which typically is about 12 weeks on average, to 16 weeks on average. So it's that time of raising capacity in those trailing edge nodes, one, and then two, obviously the back end assembly and test is tighter. I think as it relates to that, I think there's a couple of things on the back end. One, is the lag of hiring wafer or workers and bringing them into the facility, training them, et cetera, and all. But two, I think, if you look at the significant investments in the back end made during the COVID and some of the geopolitical disruption that we've had here over the last several years, many suppliers have worked for optionality, right? So they've moved testing houses outside of the China region. They've relocated into Malaysia, Vietnam, etc. And so again, as they've ramped, and I think I may have shared this in past ones through the FasTech series. The question that we always had was, how quick can that part of the market ramp? Because you're not just ramping the factory, you've got to ramp the labor, and those labor pools are relatively immature, what you find in China. So again, I think you are having just the lag and ramp, one, but two, you're also having, some impact of the optionality that the supplier base across the board has looked to provide to the customers as they've seen additional, or they've seeked additional options outside of China or China, Taiwan, plus one strategies, et cetera. Just to drive down a bit, outside of the compute and foundry space. So this is looking at the analog passive discrete market. I think there's a very, very similar story. As you can see, we saw significant CapEx growth through the late 2010s correction and ultimately sharp growth. That was obviously led by Texas Instruments, that was ramping their capacity significantly. That's good for a nearshoring, that's good for global security, but that ultimately drove a lot of capacity. So again, that industry is quote unquote found religion in 24, 25. Obviously the downturn was longer and more painful for that space. So I think, where we are right now with roughly call it a flattish outlook for CapEx to slightly down, I think that's reflective of those guys digesting significant investments that were made during the last up cycle. To put a rule of thumb out there, for your broadline semi guys, I would honestly put front end utilization somewhere in probably the 70 to 75% range on average. Obviously, it differs and depends by supplier, end market, et cetera. But again, for a rough average, which is almost a fool's errand, it's probably 70 to 75%. So there's still capacity there. We just need to ramp it. So I think you could look to this space and look at what you're seeing with some of the lead times going out is more of a ramping bottleneck than a significant capacity shortage like you're seeing in memory. And just to throw some numbers on it, and again, I won't leave the slide, but it'll be, for those who want to take a look at the actual data behind it in the basket of companies that we're tracking, this is what the actual dollars of CapEx look per year. So, that's the capacity side. What's going on the inventory side? So from an inventory standpoint, I'll be the first to say, with this is backwards looking data. This is a bulk of the fourth quarter data. As you mentioned in some of the charts, some of the Asia data also isn't available yet. They're on a reporting lag for the fourth quarter, which I know is crazy. But all in all, a couple of things that jump out. One is, I would say the inventory levels are largely normalized on a days basis right now. So, and again, you could look at the quarter over quarter, year over year change. They are largely what we would consider normalized. With that being said, the dollars of inventory are still significantly elevated. And really, I think that's just a new dynamic and reality for the industry when you're looking at what has transpired, let's say in the AI space, a NVIDIA GPU and system for AI, that overall rack carries significantly higher ASPs than a standard x86 inference server. So I think that's being reflected in the dollars of inventory. It's also being reflected in the days because as that stuff is sold, it's sold with a higher cost of goods based on a higher price, et cetera. So, inventory exit in the year actually looks okay. It is really the punchline for this. If you drive down, in the segments, especially on the dollars basis, I think some eyes probably would be raised at the year over year change around the comm suppliers, the distributors, the ODMs, EMS space, and the OEMs. Again, outside of distribution, I would tell you in the other one, the comm suppliers, those are guys like Broadcom and Marvell. They are levered to the AI spend. So that discussion on dollars versus days is very prudent there. The ODM EMS space, that year over year increase is largely driven by the ODMs or the EMS providers that are levered to AI. And then again, from an OEM standpoint, the data that we sampled does skew more to the compute marketplace, which again is a similar story that I shared from a top-down standpoint. The dollars are being driven by AI and don't actually raise a lot of red flags for us. Looking at it more real time, and I think this is arguably the more important slide. Through a partnership with an industry organization, Edgewater runs a sentiment survey on what our inventories levels for semis, interconnect, passives, and then customer standpoint. So a couple of things that jump out to me. One, you see the semi sharp downturn, and that's obviously being heavily influenced by the memory space. Two is the customer downturn or the customer inventory levels that really going back to kind of the March period, ultimately eclipse that kind of too high and more into, kind of a leaner territory. So customer inventories, looking at the tail end of 1Q last year into 2Q, ultimately started to normalize. You mix that with a couple of, start and stops, I would say, in the recovery last year that were driven by some geopolitical tariff disruptions. And then you throw on what's transpired starting in the fourth quarter with memory, the customer base has clearly moved from a sentiment standpoint from inventory drawdown to inventory to supply sufficiency. And I think that's been the ultimate shift that's driven this recovery that really took hold in earnest, call it October and in November, and momentum continues to build here throughout the first quarter of 2026. Likewise, again, on lead times have moved up, and then ultimately we'll shift over here to the end market outlook. We'll touch on a bunch. This was where I will address that question on what does it mean from an end demand standpoint. So first and foremost, we'll start with the PC market and walk through kind of the range of outcomes for this year. So going back to the start of the year, forecast for the PC unit growth in 2026 was roughly a 5 to 6% year-over-year growth. That puts units somewhere in the 200 to call it 285 million unit range. For those of you that have been on these in the past, I think you'll be familiar when I said, we ultimately believe that the PC market's roughly a 275 million unit market. In a good year, you're above that. In a bad year, you kind of fall back to it. So again, everything was set when the budgets and forecasts were set in the fourth quarter. Everything was set for what I would call, a relatively robust or good year in the PC marketplace. What I can also tell you is while these are the official forecasts, these are 100% wrong. So while unit forecasts have not changed, based on the situation with memory, realistic unit growth this year is expected to decline potentially 10% year over year. So we're looking at roughly a 15-point decline, or 15-point delta, I should say, versus the original forecast. That amounts somewhere in the, call it 30 to 40 million unit range from pure memory demand destruction. It's important because it's twofold. It's not just the price that I showed in the 217 or 28% year-over-year increases in the first half of the year. That is certainly part of it, especially when you think to the low-end market where OEMs try to target 10% of the BOM, or 10% of the retail box in memory costs and storage costs. That equation is completely thrown upside down, but there's also an issue of will they actually get surprised? Or supply, I should say. It is impossible to say who the have-nots are. It's pretty easy when you look at the memory allocation to say the haves. The haves right now are the allocation chain, if you will. Anything related to the NVIDIA AI platform is probably tier one. Anything related to the hyperscaler cloud market, so think your AWSs, et cetera, of the world, they're two. Your third one is basically the enterprise or the Chinese hyperscale market. 4 is your enterprise server. 5 is PC smartphone. 6 is consumer embedded other. So there's your allocation change. So again, the risk is not only does the price not work, but also the risk is do they actually get enough supply? Natural question, why have you guys not changed your forecast officially yet? It's hard to predict the exact doomsday. The numbers haven't shown up necessarily yet in our research in the first quarter. As you all know, the OEMs do have inventory, so they can somewhat quote unquote dollar cost inventory, dollar cost average their DRAM and flash inventories for the first quarter. But again, as we move into second quarter and third quarter in particular, and what would be your more normalized peak builds around the consumer, I think that's where the risks could surface. And I think this year will end up more closer to down 10 than the up 5 to 6 range. Secondly, from a server standpoint, so I'll walk through the server landscape overall. So completely unconstrained server demand, meaning there's no constraints from a processor standpoint, there's no constraints from a memory standpoint. Units would grow 25% this year. That's where the forecasts are. And that is, although I hate the term unprecedented, when you go back for the last 12 years, that's a number we have not seen. It's actually significantly above. So if 25% is what units are forecasted at, the supply constrained unit is actually, or forecast is actually closer to up 10. And then again, we're at the 5 to 6% range just because candidly, it's hard to forecast the haves versus the have-nots. So what does that look like, across the segments? I think if you look into the AI space, that market again will probably double. If you look into the cloud hyperscale market for, again, your kind of core cloud service offerings, I think that's been the incremental change. Those units will probably be up, call it 10 to 15% this year. And what's ultimately changed there, or what's driving it, and again, you never know the exact decisions, but I think if you look at CapEx dollars from your major hyperscalers, they've grown arguably exponentially over the last 3 years, and a bulk of that has been playing catch up in AI. So your core data center investment has been, I would say largely on kind of a life support or a maintenance level. And they've run to the equation after overbuilding during the COVID years, they've run to the level where they ultimately need to invest. So you've got strong AI, you've got strong core data center demand, and then again, you've got a continued, weaker relative enterprise on-prem environment. So, again, while the server outlook, even at 5 to 6, if it makes 10 even better, is robust, when you think about what the potential demand destruction, again, it's not all memory here, but you're looking at roughly a 10% gap, between what they, or I'm sorry, a 15% gap between what they could be and what they ultimately probably will be. So again, that's processors, that's memory, but it's real. So I think, there's certainly significant, quote unquote, risk to the real demand in the server place, even though the outlook is very, very robust in the server market space. Smartphones, I'll touch on this one very, very quick. So I doubt it's probably a big market for anybody here. But again, to the demand destruction side, I think that's the most important. So we were a 1.224 billion unit market with 880 million 5G devices. Forecast this year on Jan 1 were 1.2 and 960. So, one from a mix standpoint, sure, you've got a little bit of a 5G kicker, but not nearly what you had going back to 19, 20, 21, et cetera. The real important thing here is of that 1.2 billion, again, similar to PCs, I think the real number could be somewhere down 10. So we're looking at roughly 120 million smartphones that might not be built based on memory shortages. Story is the exact same space, same as the PC space, but just between those two markets, we're looking at, call it anywhere from 150 to maybe 160 million units that are not being produced based on the tightness in the marketplace. So again, that's how you could get that potential hypothetical incremental capacity story, but it's ultimately a big ask to kind of hope, and hope is, to borrow the old corporate cliche, hope is certainly not a strategy to run your business. Moving out of the compute and smartphone markets and into the automotive market. So, good news, bad news, I would say, across the overall automotive marketplace. So the good news is, production's forecasted up, it ended up being somewhere in the 88, 89 million unit range, roughly flattish last year. It's flat to up a point or so this year. So again, we're well off, the peak global production rates. But again, this is still a market that works. So the bad news is ultimately the mix as we look into 2026. The biggest driver over the last several years has been the China market, in particular the China EV marketplace. That market, with the subsidies declining, et cetera, is forecasted at flattish. I think it's not terribly unreasonable in the Americas to think, the EV marketplace is flat to slightly up or even potentially down. So call it flat plus or minus. So yeah, I think, you're in an environment where overall production is flat, which is not bad. You're not getting the mix, quote unquote, kicker of the content driver as you move further into the EV adoption curve. So, net in the environment we're at, I think the right way to think about it, if you're a component vendor, is this is probably a market that grows 6, 7, maybe 8% if you have some luck with price in the year. But again, with the mix shift, assuming we don't enter into a mass shortage, very, very hard to see an environment where you're approaching double digits unless you happen to be levered to a certain program or idiosyncratic event for your own existing company. As we move out of global production and we move into the SAR, or seasonally adjusted run rate for the US, or a signal of end demand, last year finished in the 16.5 million unit range. Again, this year's forecasted flat. So a pretty similar story here. What I will tell you is the biggest risk to this is memory. For those of you that are engaged with any of the auto customers, I'm sure you would attest to this. Every single conversation they're having is ensuring supply sufficiency. I think it's a little bit of a good news, bad news scenario there. The good news is, based on the initial forecasts of roughly flat across the big three and the tiers, by and large, at least for two of the three tiers, I think they've entered into quote unquote contracts where their volumes are at least secure, so they'll have supply sufficiency across programs this year for what they forecasted, but there's no upside. There is one of the OEMs, the one European of the big three. They were not as aggressive in their negotiations, so I think they're scrambling a bit more than others without the supply sufficiency. But again, I don't think there's a huge level of material risk. While the memory pricing, to use a technical term, has gone bonanza, I think it is important to note that, by and large, the memory market is mature enough that you could typically find whatever you want, even from non-traditional gray broker markets, et cetera. You could find whatever you want. The question is, do you ultimately want to pay for it? So I think we'll be able to avoid any significant disruptions from just memory supply sufficiency here. The real question, I think, ultimately means end demand. Interest rates are higher. We all know what's going on with gas prices. I think it's too early to tell if that flips that discussion right now to more EV, to more hybrids. At a face value, it looks like it should be a relatively better year for the internal combustion engine than years past. Again, too new with what's transpired in the Middle East to say if that's changed here in the near term. As we move out of automotive and we move into the industrial market, I think, a couple of things here that are important to highlight. So first and foremost, if you look at, kind of the post-COVID swings, this has been a stable, low single digit grower from a overall top-down manufacturing in the US. Some months are up, some months are down, right? And this is all consistent. I think if you look at monthly PMIs that have hovered right around, call it 50 plus or minus, so either, moderate growth or moderate contraction environment, that all checks out. I think when you look backwards, we all know what transpired with a very long and arduous inventory drawdown. As I mentioned, from the customer side, the good news there is that the inventory levels appear clean. But I think the most important thing starting in the fourth quarter here from the industrial marketplace, and to summarize it in one line, is you're starting to see the tentacles of AI drop down into the more traditional markets. So traditional industrial markets. So what do I mean by that? At the end of the day, for the last 3 years, this quote unquote recovery has been, and I know I've run this slide out in this webinar before, a rising, just because we're in a recovery, rising tides doesn't raise all ships, et cetera, and all. The recovery, which we've been in a recovery technically since about the first quarter of 2023, has been entirely NVIDIA driven. So it's been all AI, and the rest of the marketplace has floundered. It is incredibly good news that you're starting to see, I think, the impacts of AI spend dropping down. And when you think about it logically, it's not that hard to think about, or it's not that hard to understand why. You can look at, the capex for the major hyperscalers this year. They're talking 700 and I think $60 billion is the last number I checked. At the end of the day, we are going to build a ton of data centers, and as we build those data centers, we need to cool them. So, this is dropping into the HVAC market. You need to hook them up to the grid. So when you think of generation, transmission, storage, those types of spaces have seen, you know, they have seen what I would call is a significant change starting in October and November. So again, you have inventories being clear. There was a geopolitical tension around a discrete supplier in October. 2, and then 3, you actually saw some level of demand as this AI spend really went into the more traditional environment. So, that's where we get to where we are. Where again, I think we're in a healthy recovery right now. If I were to put a number, excuse me, on for this year, you could be approaching, somewhere in the 10 to 15% range. For those that have heard me speak before, I think, you probably recall I've said, I viewed the industrial market, all else equal, clean inventories, etc., a 6 to 8% grower. If this AI drop down, for lack of a better term, if this does continue to have legs, I don't think it's unreasonable to say, going from a 6 to 8% type CAGR to, anywhere, 8 to 12% CAGR. So significant change in the demand profile. There's also natural markets like, ATE, the automated test equipment market, that's seen a benefit from the memory and AI spend. But again, I think anything around power, anything around HVAC, anything around the data center and connecting it to the grid has certainly turned a corner. So with that, what does all this mean? So, I'll run through, my sales forecast for the year. And again, I'd be the first to tell you, the 27% top down number for the industry is too low, solely based on memory. I have my memory number up 45%. I showed the major pricing SKUs 200%. Just as a proxy, Micron's fiscal 26, I think they're going to do something like 90 billion. Last year they did 35 billion, right? So I could go through all the examples why I could get way out over my skis on the memory market. I'm taking it kind of month by month, to be perfectly candid. So know that 27% is a darn good year, and there's probably upside due to the memory space. When you strip memory out and you look everything, including the logic, we're at 20%. I think that's more of a realistic number. Obviously, the big swing factor in that is NVIDIA and the other AI processor companies. There could be upside there, candidly, but again, I think most of the upside from this year at these levels would be in memory. And then lastly, again, 8% versus, 6 at the start of the year. So we've already come up a bit as the first quarter has transpired for the broadline X memory, X logic segment. Again, if you ask me to handicap this in a range of outcomes, is this too high or too low? For this year, I'd probably tell you it's too low. And I think as the year unfolds and the supply continues to tighten, it's probably more of a 10 to 15% type market. So again, numbers overall are going up. I am proactively managing it. For those that might ask, it's just a matter of how far out, how far out over your skis do you want to get when it's largely price driven. Interconnect sales, so again, have this at 11%, feel relatively better with this number. The AI has been a much more significant driver. Inventory levels have been clean. Um, Again, is this too low? Is this too high from a range outcome standpoint? What I would tell you is, we've seen multiple price increases. So I think, there's probably some additional price tailwind that could take this higher, as all of you know, just because there's a book price or a catalog price that often doesn't translate into the contract price. So, being prudent at the 11-ish% range, but again, feel that there's probably more upside with the interconnect pricing and a continued healthy recovery and the demand kicker. And then, similarly, we're at the 10% number for the passive space. We are seeing the pricing going up in tantalums. We're seeing the pricing go up in aluminum. So again, very, very similar to the interconnect for passives, where I think price will be the biggest driver today. Couple of things, that we're watching. The elasticity equation right now, I think that seems moot. As I mentioned, the OEMs have clearly moved across all markets from inventory drawdown to supply sufficiency. Memory is certainly leading the charge there, but I think that's dragging through. And then again, where are we with the AI spend? It is very, very hard to handicap. I threw some numbers up there that are astounding. What I will tell you, and I could question, and another question I get all the time, is this a bubble, etc. Um, you know, well, I certainly think at some point the market needs to correct and these companies need to ultimately make money with the services they're provided, at least here in 2026 and the early outlooks for 2027. For those of you that are Spaceball fans on the call, it's ludicrous speed go for the AI marketplace in this year and next year. So with that, I will pause. What questions do you guys have?
I am going to give everybody the ability to use their microphones. Okay, everyone should have the ability to unmute yourselves. You did have one question come in a minute ago. How much revenue upside is pure price increase and how much is driven by actual unit growth?
Yeah, so that's a great question. Yeah, I think the way I would think about it is, again, and this is why I say my memory number is way too low. So if I nothing changes where we are from right now, you have 25% production growth. We're in an environment where by and large every bit of production will be used. So call it, 25% in unit or bit growth, and that would mean I only have 2% of price, which is completely wrong. Um, Anything above that 25% number would be price. So again, if you want a straight line and say memory is going to grow 200% this year, which that's what the pricing is showing. It's hard to believe when you mix and everything else that it all works out that way. If it were whatever the number is 25% unit and the rest would be all price.
Thank you. If anyone would like to unmute themselves to ask a question, please feel free, or please feel free to put any other questions into the chat. Um, we also had one question around the DDR5 slide that you did. Do you happen to have any information pulled on DDR4?
Um, I don't think it's updated. For whoever's asking, please reach out directly. I've got to dig. I know the DDR5 is the mainstream. I don't know if we have the updated one. I'd have to dig through. So please reach out and I can let you know.
Perfect. Do we have any other questions? I don't see any other questions coming in. But thank you for all the great info, Dennis. You did an awesome job with the presentation as always.
Hey,
And
Amanda, it
yes,
looks like a question just came in. It just says, can you please touch on how volatile the pricing will be? I assume that's a memory question.
Good question.
But other
Sure.
components, we're starting to see it too. So
Yeah. I was gonna say I think overall, again, nothing changes on that demand that demand equation or the elasticity doesn't show up into the hyperscale market. I don't know if there will be much volatility there. Secondly, yeah, when I was at a conference presenting a couple weeks ago, someone before I jumped on stage, who I'd known for a number of years, asked a simple question or not a simple question, but asked a question, it feels like we're off to the races again. Lead times are going out, prices are growing up, et cetera. Do you think everybody learned their lesson from the last up cycle, meaning the COVID one with non-cancelable, non-returnables and the price increases and how that played out with the long downturn, et cetera? So, long story to say is, I think as it relates to the non-cancelable, non-returnables, I think the proof has shown out in results. The companies that were more prolific users of non-cancelable, non-returnables, their downturns and, one from a steepness, was significantly steeper than the others who didn't use them in earnest, and two, their recovery is much more drawn out. So I think, very objectively, I don't know if we'll enter into another mass environment of non-cancelable, non-returnable programs, but I do think things that'll change. And for the longest time, I've been the biggest proponent of the industry that, the more things change, the more they quote unquote stay the same. But I do think, what has changed is, I think if you look historically across, the broad line or the analog or the microcontrollers, in a good market, they would give up 1 to 2%, maybe hold pricing flat. In a tough market, in a downturn, they would, give up 3, 4, 5, maybe 6%. And that kind of netted out to your 2 to 3% increase. I think through the last upturn, the executives at a lot of these companies realize that, you know what, we can also take a company lying down with the best of them. So our products are important. They're hard to manufacture. And when the market turns, we're going to lean into price. So I think, if you look this year, again, unless there is significant demand destruction, which, again, I walked through the PC case, I could do some math on what that matters for memory. I don't think it would drive anything in the broad line space. I think this year overall is probably a move higher across the board versus an overly volatile price environment.
do you have any other questions? All right. I'm not seeing anything else coming in, but if anyone has any other questions that haven't been answered, as Dennis mentioned, his contact info is going to be in the slide deck, so you can feel free to reach out to him or reach out to me, and I can connect you. And with that, Dennis, thank you so much for taking the time to present to us this morning and sharing your insights. And thank you to all of our participants for attending today. And we hope that you enjoyed the presentation. And I'll be sending out that recording and slide deck in the next couple of days. And we hope that you have a wonderful day.
Thanks, Dennis. Thanks, Amanda.
Thank you, everybody.
Thank you.
Appreciate it.
Thank you.
Thank you.